Hi, welcome to the Stingy Investor Q&A. Today I'm fielding a question from Ray, who recently read the June 2015 edition of Money Sense magazine. I have two articles in the magazine. One is called Where to Invest $10,000, and the other is called Where to Invest $100,000. When they're posted online, I'll provide a link to them below. Both articles highlight low-fee balanced portfolios composed of active or passive funds. The active funds are run by portfolio managers who actively pick which stocks and bonds to buy. The passive funds look to simply buy a little bit of the whole market. Ray asks, if the more funds beat their benchmarks, why invest in ETFs that, by definition, will at best achieve the benchmarks? It's a very good question. In the first article, I highlighted two more balanced funds, one for taxable accounts and the other for tax-sheltered accounts. Over the last 10 years, both have beaten their benchmarks by about 1.5% annually, and that's after deducting an annual fee of a little less than 1%. They've done very well indeed. On the other hand, a couch potato style portfolio, composed of Vanguard ETFs, with a few commissions thrown in, costs about 0.2% annually. It tries to track the market benchmark on a before fee basis. So in the past, the more funds cost about 0.8 of a percentage point more annually and provided a 2.5 percentage point return boost on a before fee basis. But that's the past. I simply don't know what's going to happen in the future. So the question becomes, how much are you willing to pay for a chance to outperform while taking on the risk of underperforming? If you're an index investor, you're probably not willing to pay a premium because you don't believe Moore's return advantage will persist. Personally speaking, I'd be happy to pay a small premium, but I wouldn't want to pay anywhere close to 2.5 percentage points annually. Overall, I think both passive and active approaches have their merits. If forced to pick one, I'd lean to the active side with the more funds. But investors will likely do reasonably well with a passive portfolio of Vanguard ETFs. So it'll be interesting to see which side wins over the next decade. Until next time, thank you for listening.